Good morning, good afternoon, everybody, depending on where you are. Welcome to Treasury Springs 2020 in 20 minutes. So Henry and I will be guiding you on a whistle-stop tour through the money markets and what happened in what was a pretty extraordinary year. Hey, Henry, how you doing?
Yeah, good. Thank you, Kevin. Great to be here. Looking forward to this.
Indeed, let's see if we can keep it snappy. We've got a lot to get through because it has been quite the year. I don't think either of us would have predicted it when we were back sort of planning what we were going to do in 2020. Maybe if we try and cast our minds back to that, I remember, do you remember when we used to go to the pub?
I do. I miss it dearly. Some of the best ideas came from there.
I remember one of those conversations back in January and sort of trying to think about how the year might pan out. And I think both of us maybe thought we were sort of mid-late cycle from a credit perspective, might be some unsettling times, we might see some interest rate cuts. Anything else you remember from sort of January time?
Yeah, absolutely. So, stock market started very strongly. Certainly, what concerned us was the degree to which corporate issuance had taken place in the prior year, and that theme seemed to be continuing. But all in all, a fairly standard start to January with stocks being bid, people coming back, optimism in the market. We did see those mid-cycle cuts from the Fed, but generally speaking, I think no one expected rates to be going down a huge amount, frankly. So, yeah, there was also a yield curve.
Oh yeah, I remember that. So if we look sort of where our timeline starts here, and we'll make this timeline available to everybody so that people can peruse it in their own time. But you sort of look, the first couple of entries, S&P closes at record high 19th of February, 28th of February, just 9 days later, stocks report single largest week decline since 2008. So, maybe some of that fragility that we were perceiving right back in January, evidenced by the fact that we saw really precipitous falls on the back of the first realizations that this virus was something that wasn't just going to affect a Chinese province, but was actually really potentially going to spread itself worldwide. February, I guess, was just the appetizer to the main course in March. And if you look at the timeline, an awful lot of entries for March because an awful lot happened. I know that we were both sort of sat in similar seats, albeit different, back in 2008. Do you want to talk about how March felt to you versus something like September 2008 and what the screens were showing you?
Yeah, sure. So, as we all know, different crisis for different reasons, but market reaction very similar in terms of flight to quality, sell anything that is anyway slightly risky. Red screens, gigantic sell-offs, large bids on government assets, emergency rate cuts, central bank stimulus, liquidity drying up. It had all the characteristics of a severe downturn, and I do mean severe and acute. We preach resilience, and it's precisely for these reasons. Not that we predicted any of this, of course, nor could we ever claim to, but these things happen.
Yeah, and I think that was the story, wasn't it? You saw that massive evaporation of liquidity. We saw even AA names seeking funding at hundreds of basis points wide of where we might normally see them seeking funding, as we saw people rotating into government assets, out of prime money market funds, out of deposits, generally, away from anywhere that they're perceived to be risk, and into the safest thing we could, that sort of traditional flight to quality trade. Placing significant strains on the machinery of the money markets. And I guess what was perhaps different this time to 2008 was the speed and size with which the central banks moved through March in order to put the sticking plaster on those bits of the system that were bleeding, and give the patient at least a chance of recovering on the other side.
Yeah, absolutely. In some ways, not many, but from this perspective, the global financial crisis of 2008-09 was a blessing in disguise. Central banks were more prepared. They were able to act faster, in size, and coordinate fairly well across jurisdiction. For example, opening up of dollar swap lines, for those offshore seeking US dollar that were shut out. So certainly very useful there, but
yeah, a veritable sort of alphabet soup of recovery packages, both for the money fund sector, for the banking sector, for the corporate sector, for employees, really kind of turning on the taps in every possible way that they could in order to get money into the system to try and stop those, not just the financial implications, but of course the very real world personal implications that we saw. I think you'll remember well, was it the Wall Street Journal or the New York Times who had the front page showing historical unemployment rates in the US since the Great Depression, which sort of potted across the title line nicely. And then the shock unemployment we saw coming through April of this year went from the top of the page all the way to the bottom of the page. And so, really pretty extraordinary real world effects, not just financial effects.
Yeah, absolutely. And the thing about that graph, it was the Wall Street Journal. The most concerning thing about that is that actually that was only partway through the story. And in fact, if you were to redo it at the peak of those terrible unemployment prints, you'd probably not even see even a smaller sign of a wave across that top line, frankly. The rescaling required. Awful.
Yeah, for sure. Other things that we saw, I guess, through March, we saw a little bit like we saw in 2008. You saw some of the big money fund providers step in to support their money market funds in addition to government central bank liquidity that was being provided. So you saw both Bank of New York and Goldman step in to the tune of $1 billion or more in order to shore up those, really to try and prevent a run on those maturity transformed structures, which we really were not a long way from, I don't think, back in March. And then you started to see the potential credit impacts, I guess, as we came out the back of March, people looking at this and saying, okay, firstly, Moody's issuing a warning on the European banking sector, saying, look, this is going to be a challenge for the banks with bad debts coming, with net interest margin cut. Then people revising outlook for the prime money market fund sector as well. You saw Fitch doing that. And then, people also looking, saying, hang on, what does this mean for corporate debt? Bank of America making predictions on the 7th of April that the amount of corporate debt moving into junk status for the year could reach 200 billion. We talked a little bit about the fact that a lot of that issuance that had been done in 2019 was in and around that BBB, BBB minus, BBB plus sector. Obviously, those potential crossover credits where, I think certainly coming out of April, there was a worry that a lot of those companies would fall into sub-investment grade, and that would naturally cause further funding stresses for them, and could have ended quite badly. I guess, again, things that you might have expected: cash levels being held by fund managers going up to the highest levels since 9/11. So I think there were certainly some things that, particularly given our knowledge from 2008, you could kind of predict: gold rallying, cash rising, equities down. But there were some things that you probably couldn't predict as well. So 20th of April was an interesting day, Henry. I remember turning on for our morning Zoom call and seeing you with a background of a load of burning oil barrels. What was that all about?
That was to get rid of the supply that was coming down the pipeline, because frankly, there was nowhere left to store it. Look, I'm not a commodities trader, no energy expert, but certainly I felt like, and I've been rattling on for, since the beginning of the year prior to this, that my feeling was that we'd seen peak oil, and I still believe that. But super interesting article that will add to sending this timeline out around what actually happened here with oil going negative. And in fact, the story it's a really great read. It's one for sitting down with your cold turkey and going over how just a small number of traders based from home, living in Essex, managed to hugely profit from everything that went on. Yeah, fascinating read, honestly. Take a look.
Yeah, no, a lovely story. And, but just, again, fascinating that it was another one of those years that really reminded you that unexpected things do happen. The entire oil market got caught the wrong way round on this. An awful lot of people lost an awful lot of money, as well as a small handful profiting from it. But if you sort of back closer to home, and looking at that government support, I guess the other thing that was noticeable was that central banks started to go further than they'd ever really gone before, with specifically purchasing things like corporate bond ETFs in order to prop up those sectors. So you can see in May, more than $100 billion being injected by central banks to support commingled fund structures. Again, question whether you should ever really be in a position that you need to do that. But the fact is we were, and central banks did, and kind of all of the historical rule book was thrown out as they said, we just need to make sure that the system is shored up.
Yeah, absolutely. And I mean, all of this, negative oil prices, the propping up of various parts of the financial markets that should really be part of Adam Smith's free hand, frankly. Receiving that support, it's hard to put into words, I guess, how that looks and feels in the market. But the word that sums it up best is just panic. A real liquidity crunch and crisis in the market, and that only really survived due to those very, very unprecedented and measures that came in. And
yeah, but I think again, that if we look at unexpected things, I don't think that anyone would have predicted at the start of the year that Zoom, the excellent piece of technology which we're using for this, would be worth more than the 7 largest airlines in the world, which was the case by the middle of May. There was also a brief moment in the sun for the lesser known Zoom Technologies, I think. I'm not exactly, you probably know better than me exactly what happened to the stock price, but that was quite funny.
Yeah, so look, rise of the retail investor does cause some interesting distortions, substitute retail with amateur investor, not in a disrespectful manner, but you should be getting your tickers right if you're spending money, and by ticker, that's the abbreviated name for an equity listing. And so people going in heavily into Zoom Technologies, mistaking it for this particular piece of software, and that stock price rallied up to $20. Now, to give you an idea of where it is today, where it was prior to the pandemic, it is trading at 17 cents.
Yeah, be careful when you're trying to get on the fast-moving bus that you get on the right one, I guess.
Yes.
Otherwise, you can end up in a place that you didn't expect to. Sort of back to money markets, May saw the first of the prime money market fund liquidations from Northern Trust, a theme that we'll sort of see as we move through this. But people sort of looking and saying, okay, in a world in which rates are lower for longer, in a rate where there's too much money chasing not enough product and there's not enough credit spread in those traditional sectors, in a world where prime money market funds have shown themselves to be a challenge in terms of the way that they deal with crises like the one that we saw in March. We've seen a number of those providers looking to close funds, looking to convert funds into government funds. And Northern Trust was the first of those back in May. I guess you're sort of starting to see as we move through May and the early part of June, an element of reflection, an element of what went wrong. Why did the central banks have to step in quite such a large scale? What are the things that we can look at going forward? So you've got Andrew Hauser, Director of Markets from the bank, talking about the fact that we really maybe need to look at money market funds again. And then also what we saw was further efforts from the central banks to stimulate the real economy. So you've got the financial system, you've got the stopping the bleeding, and then they started to look to say, well, how do we actually get money out into the real economy? And you saw this $1.3 trillion, I won't call it a present, but $1.3 trillion offer to the banks in order to try to stimulate real lending, I guess. What were the effects that we saw of that in practice?
Yeah, so to get to this point, we had the destruction of the yield curve, the destruction of the credit curve, and then this huge amount of cash coming in for term from the ECB. Some of it printing as low as -1. Some of the tenors longer, so out to 3 years. The idea being that with net interest margin, basically the way a bank makes money is where they borrow and lend. Historically, that credit intermediation is not necessarily rocket science, not to pay it any disrespect, but essentially with negative rates and compressed credit spreads, banks simply can't function in that intermediation space and performing the role in a manner that's profitable. So, what do? Make money even cheaper for those banks. And the thing is that in part this did have an unintended consequence, or maybe the scale of the consequence being that actually there was a big rally in government assets, and whilst that is useful for benchmarking versus then where other credits issue. So here I'm talking about for example SSAs, and then your various range of credits on top of that. Yes, it brought down borrowing costs, but the scale of the rally just in government assets, and the fact that to create that scale of rally, clearly a lot of that money has gone into the government assets as opposed to into the real economy, is signified by what happened, for example, with the Italian 1-year bill. And so, coming into this, we were looking at it trading at sort of 25 basis points. From us, we were looking at it and saying, hey, potentially this is a product for some people who already park their cash in a low, in some lower rated credit than that. Here's a chance to get into investment grade and actually get a positive yield, because even before this, actually in 2019, we had record levels of sub-investment grade issuance that was trading negatively. Crazy, but that's the world we lived in. And so, that 1-year Italy trading at 25 basis points prior to this, and then, now today, looking at the screens, we're looking at around the minus 50 basis point level. So that's 75 basis point shift without a change in the underlying benchmark interest rate. So it just shows you, the velocity of money and where that money has ended up.
Yeah, and perhaps not where you might have chosen for it to end up, in terms of its ability to really help stimulate the real economy. Sort of moving on, I'm conscious of the fact that we're approaching, yes, the second half of the year, but also the last quarter of our time. We are sort of, if you look at July, some incongruous headlines, I guess. So S&P reaches nearly 1,200 downgrades so far for the year, just short of the record set in 2009. Then you look at highest loan loss provisions by the 15 largest and 32 largest European banks, being the highest since 2009. Add to that global pandemic, world economy shut for months on end. Next logical conclusion, S&P 500 index closes up at record high. Don't have time here to talk about whether that was driven by discount rates, whether that was driven by retail investors, whether it was driven by a wave of misplaced optimism, depending on your views, but nevertheless not necessarily things that you would always put together. Kind of moving through September, you saw Vanguard convert the largest prime money market fund in the world at $125 billion into a government fund. $125 billion, or so the number again, just because it's a big one. That's $125 billion worth of funding that was going principally into the financial sector, going out into the governments, putting more pressure on those government rates. And then on top of that, you see other fund liquidations continuing to come through. More recently, we've seen some of the lineup from Northern Trust closed some earlier in the year, closed more later in the year. So Vanguard, Fidelity, Northern Trust, and I think that theme of closure, consolidation, switch to govy funds is definitely something we've seen over the course of the year, against also that backdrop of, again, we started to see more. You can see it here at the Fed coming out in September saying that we need to make money funds less susceptible to runs and find a way to look at them differently. And also people looking more broadly at regulation of the financial sector. I think one other theme that's worth touching on, and you can see it here in the McKinsey report in October, was just the amount of money that has made its way into some of the largest corporations versus the amount of money that's made its way into some of the smaller corporations. McKinsey coming out and saying 55% of European SMEs could go bust by next September if revenues remain at current levels. On the other hand, you can sort of scroll down and we'll see that US investment grade bond volume registers 912 billion through September 30th, up 77% at the same time frame. I know, Henry, you have views on the fact that in not just, I guess there's been some talk about distinctions in inequality in our personal lives and how that potentially has been accelerated in an unhelpful way by the pandemic. But in markets, we've also seen it in the corporate borrowing space.
Yeah, absolutely. So, the thing that we've seen, obviously, coming into this year, already very high debt levels. Now, whereas considerably higher again, what does this mean for the future? Well, there's going to be drag trying to pay all of this stuff off. So, yeah, I'd be very cautious about more issuance. But then, the German central bank is due to issue a record amount of debt, 471 billion euros next year, to pay for various programs that have been rolled out and to provide further support going into next year for some of those heavily hit corporates. Rishi Sunak again this morning, though, taking the opposite view of we need to start tightening our shoelaces up here. We cannot continue to borrow at these levels. Interesting article from the Financial Times this week. We'll include the link with all of this, highlighting the fact that in the US, whilst lending to corporates has increased, that lending has been purely the lending that is sponsored by government. Banks have actually reduced their lending outside of that. And so, the smaller, the lesser rated, those that generally have already, prior to this didn't have access to capital markets, now further shut out at a time when they need it the most, when revenues are suppressed because of all the reasons we know and don't love, frankly.
Yeah, and I guess that differentiation between financial markets and real world is illustrated perhaps nowhere better than looking at Portugal's 10-year bond, which if you were to buy in 2012 would have yielded you a mighty 14%, I guess recognizing the fact that it's not the greatest of credits. In a world where I think the European periphery has been just as badly impacted as everywhere else, if not more so, for that to now yield less than zero, so translate that as I am paying for the privilege of owning it, is a pretty astonishing reflection of the amount of money that is in markets, is in bank balance sheets, and is perhaps making its way into government bond purchases rather than making its way out into real world lending.
Yeah.
So, lots more happening. Hopefully, everybody has the opportunity to sort of read this at their leisure. There's links to all of the underlying articles in there. Certainly, when I looked through this for the first time, I couldn't believe that it had all happened in a single year. It's been pretty extraordinary. Not wishing to predict the future, but expecting that most people looking at a review of 2020 will want a few words at least on 2021. Any thoughts, themes for people to take away, Henry?
Yeah, sure. So I think one of the themes is that, the programs that are coming through are going to be more targeted as opposed to, sort of widespread, for example, furlough, which has, of course, covered everybody. I think, government's going to have to be more specific in terms of almost picking winners or at least supporting areas that have got a chance of revival versus those that, look that they might well struggle going forward, even with further support being provided. The other thing is, to look forward, you kind of have to look back and understand what's been happening. And so those themes that we've seen will continue into next year, no doubt. Unfortunately, we can't wipe the dates, the debt slate clean on December 31. And so, I would certainly be cautious of credit here. I was this time last year. I am an optimist in life, but in credit, currently rather bearish. I'm not particularly optimistic. Continued suppressed revenues, the fact that we're still dealing with shutdowns and new ones coming up, every day it feels like in different jurisdictions. The V-shaped recovery is a bit of a myth for the ordinary person, whilst it's happened in stocks. It's that dislocation again, and that theme I think will probably continue, and the impact of that will be felt more heavily by those least able to deal with it. But I think that, on a positive tone, which is how I'd like to end, is that, there are vaccines now coming down the pipeline. We're getting better at managing all of this. Fewer things are hopefully having to close in the future. And, we can have a return to normalcy next year and hopefully do this live or at least with somewhat of an audience rather than in our...
That'd be a treat, yeah.
In our studies, yeah.
Agree with all of that. Certainly, I think uncertainty will continue. We've indulged in an extraordinary experiment this year with the way that the world has had to react to coronavirus, both in a personal perspective and in the market's perspective. On the optimistic side, on the personal perspective, I think, as you say, things will start to get back to normal, and I hate the term, but not the old normal either. And whatever new normal looks like, I think actually there will be lots of things that we've all learned from this that will make 2021 a hell of a lot better than 2020. So very much looking forward to that. In markets, caution and uncertainty, I suspect, will prevail as we try to work through how we unwind some of that giant debt pile. and try and figure out a world where that money really does find its way to the right places, that we do support good companies, bad ones are allowed to move on and capital to be reallocated. But one thing's for sure, it won't be dull. But all that remains at this point, and apologies, we probably didn't quite make 20 minutes, but we were close enough. Everything that remains at this point is just to wish everybody a peaceful, relaxing and enjoyable, well-earned holiday break. And we'll look forward to